Hello, everyone. Hello. Dedicated to financial literacy, Russell Moore coming to you live again. Um, I thought I'd start something. It's probably going to take about two or three videos to do this, but and this is for remember my channel's for newbies, good friends, and people from my church. I know I look a little sleepy today because I am a little tired, but drink my tea here, a little bit of tea. Oops, forgive me. Um, Forgive me. But yeah, I wanted to go over some basics. It's kind of the beginning of the year. I know we're in February, but I wanted to do a few videos on uh, terms, stock market terms, and definitions, and what certain things mean. And again, this channel's for newbies and babies, infants, just learning the stock market, and friends and family. And if it's boring to you, keep it pushing. Go to another channel. But I think this is important. I try to do this once a year. I usually do maybe like 10 terms, and then I'll probably do about 2 to 3 videos, and hopefully you'll get something out of it, and you'll learn a little bit. You'll learn something. Remember, if you don't learn, you don't earn. You don't read, you don't lead. I did want to make one little comment though, and remember, as a disclaimer, I do not tell people what to invest in. But there was a very important meeting that President Xi Jinping had, the president of China. He had a very important meeting on Monday. Today's Tuesday, so that was yesterday. And in the meeting, he pulled someone in the meeting that was kind of on the outskirts. His name is Jack Ma. Jack Ma used to be the CEO, previously the CEO of Alibaba. Alibaba is like their e-commerce. Basically, Alibaba is like our Amazon. That's China's Amazon. Does that make sense? So they do a lot of e-commerce work, cloud business. They do a lot. Anyway, they're a multi-billion dollar company. And he was a CEO. A few years ago, he made a comment, and that was kind of taken, I don't know if it was taken the wrong way, but China felt like, his peeps felt like, the CCP felt like he was disrespecting China. And next thing you know, he like disappeared. No one knew where he was for about a month or two, and they didn't know if he had gotten, or somewhere tortured. I don't know. And then he appeared, but he resigned. As soon as he came back, he resigned as CEO. Well, he was invited to this dinner. President Xi hosted some kind of a thing, and along with all these top CEOs in China. And basically, Qing, you don't know too much about, because they're so secretive, you don't know too much about what they said. But one of the things that came out is that President Xi said, I want to loose some of the, your restraints that we put on you guys, because you got to remember, they're a communist country, and so that's what happened a few years ago. They really put the clamps down on a lot of their big name, high tech entrepreneurs. They're like, no, you guys this is not America. You coming up under us. And they're very controlling, so they were like, They started getting a little bit loose, and they reeled them back in, started fining them, all kinds of stuff. So, but he said recently, and I think that was a response to President Trump, because remember when DeepSeek came out, and everybody asked President Trump about it, he said, "Oh, hey, that's good competition. That's why we got to get rid of regulations. That's why deregulation is important. Deregulation meaning loose the hold on money, the innovation. Let the companies be free to be creative. That's pretty much." When deregulation hits in, what President Trump is saying, look, we got to loosen some of these regulations. all these rules and laws that's keeping our entrepreneurs from being creative and innovative. And so I think President Xi, I believe he responded to that, and he had the same kind of talk with his entrepreneurs, and these are major players. BYD was there, Tencent, I think JD.com. A lot of the top CEOs in China were at this meeting, and he said, "I'm going to lose my grip on you guys, so you can be creative." So So the market responded, right? So. And I know I wasn't supposed to talk about this. I wanted to do a separate video about it. So I'm going to shut this down and go to what I'm supposed to be doing. But take a look at some of the Chinese stocks and look at what they've done in the last month. I mean, the last month, BYD, and they have cars, those small cars. They've been outperforming Teslas. 32% in the last month, that stock has went up. Tencent, 30%. Tencent, Tencent, Tencent. There's also Tencent Music. They're a pretty big company. E-commerce as well. 30% in the last month. Get this, Alibaba. Jack Ma's the guy I was just talking about that was the CEO. Alibaba has been up 48% in the last month. And I've been talking about that stock to friends. I'm like, man, don't forget, don't sleep on China, the China stocks. JD.com, another one, about 20 to 30% in the last month. The stocks are going up in China. So I would just say, do your research, take a look at them. All right? Okay, I'm going to give you 10 terms today. We're going to go over just 10, not necessarily terms, but definitions. And for those that are... you're interested in going further and deeper into your knowledge of the stock market. So these are terms for the stock market. Well, I want to first of all say this. Why invest in the stock market? Why would you want to invest in the stock market? There's several reasons why people might want to do it, but most people want to increase their financial status, their financial performance, their financial portfolio. You want more money in the bank. You want to make money, and the stock market is a great way. But there's two primary reasons why you would want to invest in the stock market. Number one is to own a company without being hands-on involved with the company, like managing it and operating it. By you having a stock in a company, you're part owner. You're part owner of that company now. You're a partner with them. And no, you're not to the same degree the type of owner where you're having the day-to-day decisions and stuff like that. But you do become an owner when you own a stock in a company. The other reason is that the stock market has averaged for the last 75 to 80 years, 10.5% of an increase. It's brought in at least 10.5% increase in portfolios. For the last 75 years, it's consistent that if you're in the stock market, you're going to make at least 10% from the stock market. Now, why is that important? Corporate bonds will get you 4.5%. A savings account will get you, 4%, 5%? But that's going to drop once the interest rates drop. So that's not consistent. U.S. Treasuries, 3.3%. Nothing's close to the stock. Stock's 10%. You're at least going to make 10%. And in some years it'll be 15. Some years it'll be 20. Right now I'm at about 37% this year. So my portfolio is outdoing the S&P 500. That's what you want. Okay, I'm at around 37, almost 40%. The goal this year is 60% for me. 60%. So there are years, where you're going to make more than 10%, but on the average 10%. So those are a couple of reasons why you want to be in the stock market. And I know they have all these other things, annuities and stuff, and insurance, and people tell you about all these other vehicles, but the stock market, 75 to 80 years of consistency, 10%, if you know what you're doing. That's true too. So okay, so the first one, the term I want to mention is stocks are bought and sold, and that's called trading. If you want to know what trading means, what does it mean? It's like, I've been trading on the stock market. If you've been trading, you basically have been buying or selling. Buying or selling. Well, where are you buying? I'll give you another one. Market. The stock market, particularly the Dow Jones Industrial Average, DJIA, Dow Jones, consists of 30 stocks from different sectors. It's kind of like an average. So if you look at the Dow, these 30 stocks, it's an average of what's going on in the entire market. Well, that's called the market. A market is where you go to buy the stock, where you go buy and sell stocks. Just like you go to the store to buy food. When you go to the store and buy food, what is that called? The market. The same thing. The stocks are in the market. The shares are in the market. And so you buy and sell from the market. All right? So, so when you're buying and selling stocks, that's called trading. Now, there are three types of traders. Well, there's more, but let me give you these three or four. Number one, you have a day trader. A day trader trades, that's exactly what it means. They're trading, they'll buy today and sell today. They buy today and sell today. Everybody say that with me. Buy today and sell today. That's a day trader. Swing trader is anything after a day. So in other words, they buy today and they can sell it tomorrow, and that's considered a swing trade. Or 2 weeks, or 3 weeks. And then you got the long-term traders. Buy and hold, we call it. Buy and hold, where you buy and you're just holding on to them. Those are long-term investors. Or I wouldn't even call them traders, investors. Okay? So I want you to hear that. Again, day traders, they buy one day and sell the same day. Swing traders, anything after a day. All right? And then there's long-term investors, or hold, buy and hold. So if you hear the term buy and hold, that's usually for long-term investors. All right? Preferred stock and common stock. Preferred stock is usually, or when I say preferred stock, when you hear preferred stock or common stock, preferred stock are stocks that are issued to shareholders they're kind of the hierarchy of the company. Like for example, Mark Zuckerberg, right? Meta Platforms. He is considered a preferred stockholder. Those are the elites, the ones that are right there, the co-founders and all that, and they get a fixed dividend. So they get money on a regular basis, and it's fixed. Okay, it doesn't change, doesn't fluctuate. A common stockholder would be somebody like you and I. We bought shares of Microsoft. But we're not. I hate to say elite because we are elite. You're elite. You are elite. You are elite. But concerning the company, you're in the lower echelon. Okay, so, but you do have voting rights. You can give input on different calls, and when they have the earnings calls, you can even have input, ask questions. You do have a certain amount of rights, but it's not like the preferred. There's preferred and common. Okay, all right. I think that's number 4. Ooh. I didn't number that, right? Okay, we'll say that's number 4. Number 5, making money owning stocks. How do you make money owning stocks? I put two down, but I'm going to give you a third one that I just thought of. Okay, the first one is capital appreciation. So you buy a stock, and if that stock begins to increase in price, that's called capital appreciation. That's how you make money. But the other way you can make it is through dividends. And I like to tell people when they say, well, what's a dividend? When the profits are being divvied up among the shareholders. Divvy. To be divvied. When dividend, divvied up. And usually those dividends are given quarterly. They can be given monthly, quarterly, annually. Depends on the company and what they want to do. Okay? So dividends are extra. That's extra income. So your stock, that stock can appreciate if you have dividends on that quarter based on the profits, depending on how many shares you have. So say it's 60 cents per share dividend. So for every share that you have, you'll get 60 cents. And they'll send you a check automatically. You can automatically have it in what's called drip. And basically, you can have your dividend, what you get back from your dividend, you can reinvest it back into your portfolio automatically. So say you don't want to spend the money. When it comes, it'll automatically go back and buy shares of a stock. It'll go right back into your investment account automatically, drip. Okay? So, earnings. Earnings is usually they're quarterly. Every quarter, so that's 4 times a year. Every 3 months, earnings report comes out from each company. Every public company has their earnings, and they report. They report what they've done in the previous 3 months. So right now we just had the fourth quarter earnings reports. The fourth quarter. I think we're finishing up in the next week or so. So they're reporting. All these companies are reporting what they did. September, October, November. October, November, December. That's the last quarter of the year. So those 3 months, they just now reported the earnings for those months. And what it does, it's a report, it's like a financial report card. They talk about what they've done as a company, the earnings, how much did they make? How much did they make in that quarter? Were there any losses? Do they have any, what's their forward guidance? In other words, what do they expect to do in the future? So it's usually talking about the financial health of the company. It goes into more things. They might go into their vision, things that they might be adding, another product, services, and all that's important because you get a chance to listen. You can listen in on those company quarterly calls. You can usually go to their website and usually it's under Investors Relations, and you click on that tab. You can find out when their next quarterly earnings report meeting is. And you can listen in and find out. And those are very valuable because they're things that companies are doing that nobody knows about, and they'll talk about it in the earnings call. And you'll be like, wow, they're coming out with something, a new product, and everybody's excited about it. Usually that stock, out of sentiment, that stock is probably going to go up. Okay, so those earnings calls are very important. I want to encourage people, if you buy stock in the stock market, be sure to listen in on the earnings calls. They're usually about an hour, and then they'll have a Q&A. All these different analysts in the industry will begin to ask questions about the company and where they're going, where they're headed, if there's any problems, if they heard something. It's a really good time to find out what's happening with that company. And a lot of times that stock is affected by those earnings calls. Usually it's temporary, but it will. You can make some extra money right there right after an earnings call. So anyway, That's earnings. Stock split. Stock split basically means most of the time a company will have a stock split when their price has gotten significantly kind of high, and some of the everyday investors have been kind of priced out. Say the stock is $200 a share. Well, if you have a 2-for-1 stock split, that stock will become $100 instead of $200. Now, it's still the same amount. It's the equity or the amount of what it's worth does not change when there's a stock split. So it's not like the value of the stock changes, okay? So that doesn't happen. You just get more shares for a cheaper price. And that's for people that have been priced out. They can get in and say, well, I can afford $90. Or say it's a $90 stock and there's a 2-for-1 split. Now that's $45. So, so they'll do that just to get more investors, to help us out. They're helping us out because they're like, you know what, this is kind of price high. And then a lot of times too, they're doing it to get in more investors because maybe they're expanding or there's a new product they need, some extra capital. So it helps. But I got to say this. The value of the stock does not change. So even though you may have doubled in shares, the price doesn't change. Okay? So that's a stock split. Going public, or what's called an IPO, initial public offering. Going public is when a company, they're private before they're public. They're private. And then they'll say, you know what? We're really making money. This product is really good. We need more money, though. In order for us, we got this prototype, but we want to go to the next level, and there's a revision to this product that we're doing or whatever. They want more money, and they'll go public. And when they go public, they'll usually go to a brokerage house. There's two types of brokerage homes. There's full service brokerage companies, and then there's discount. We are usually at discounts. Now, I do have a full service account as well with Fidelity. Fidelity actually is a discount. Usually your full service are your banks: Wells Fargo, Bank of America, Chase, UBS. Companies like that. Okay, so those are usually your full service, and discounts are like Robinhood, discount brokerage firms. Now, they don't do IPOs. The discount brokerage firms do not do IPOs. The big banks do. They have two divisions usually. The investment bankers, like your Chase, they'll have one for retail. We're basically, your everyday person is a retail investor, and then you'll have the big boys or the suits, your hedge funds that. And then they'll have a division for them as well. They have a bunch of analysts that analyze companies. That's all they do. And so the full service is usually like your big banks. And what they'll do is the company will say, hey, this is how much money we need to make in an IPO, in our public initial offering. And then the full service bank will say, well, this is what you need to go in, start as far as your share price. So they'll say start at $15.70 or $15. That's your share price you want to start at. And when you first open up your public offering, okay? And then so that's pretty much it. It's more to it than that, but I just wanted to give you just a little brief description of what IPO is. And so Fidelity, Schwab, they're not doing IPOs. That's usually the big banks. They do the big IPO, and they have a division for that. And the discount brokers, Robinhood, they're just taking care of everyday people that are investing in the stock market. All right. Fundamental and I'm going to end with this: fundamental and technical analyzing. Fundamental analyzing is, and this is how you would analyze, and this is how you would choose. The reason why I'm bringing this up is this is the two types of ways you can choose a stock or research a stock. One is fundamental, one is technical. Technical deals with past prices, charts, candles. You might hear the word candlestick. And there's so many different types of trends. They're looking at these charts to see what did it do in the past? What did this stock, what did this company do in the past, and how it's going to affect the future? Okay, fundamental is you're studying the health of the company. EPS, which I'm going to get into my next video. I'll talk about EPS. We'll talk about the different ratios. We'll get into that the next video. But for now, fundamental studies the health of the company. It also gets into, finds out about the CEO and the leadership. I look at all kinds of things as far as fundamentals is concerned. Do they have any debt? What's their cash flow like? Do they have a handle on the market, or do they have a lot of competition? Will they be still number one 3 years from now, or is their product or their service easily duplicated? I'll look at that. So fundamental checks out the company as a whole. And even if you are doing technical analyzing, I suggest that you do fundamental as well. Now, I don't know how many that was. Hopefully you were counting. But I want to say it's around 10 that I did today, okay? So I hope that you like it. Stay tuned. I'm going to continue on this. We're going to talk about the stock market and kind of give basic information about what all these terms mean. What does it mean? All right. Have a wonderful day, you guys, and I'll talk to you later. Bye.